Hey everyone. So today we're going to be talking about competitive analysis, which is basically us asking the question of how do we think about what makes a business a good business? And so the agenda for today is going to be kind of starting off with that, um, and then talking about concepts of economic profit, ROIC, cost of capital, and then finally we'll talk about moats and kind of how to protect economic profit. So when we think about investing broadly, there's a couple of questions we're thinking about, and we're thinking about the quality of a business, and we're also thinking about secondly like the price and the associated value with the business, right? And the second thing is something we'll build on next week when we talk about valuation. But the separate question that we can kind of think about as well is how do we think about whether or not this is a good business and how do we think this business is going to look like moving forward? And all of that kind of goes into this framework of thinking about business quality. Now, why do we care about that? I think it's easy to forget that in investing, um, we are buying a portion of a company's equity, and so unlike in debt, like we talked about last week, where my upside is capped, um, with equity, you know, I have a tremendous potential for upside and a tremendous potential for downside. So I care a lot about how that business is going to look like moving forward because that's going to correspond to the return that I get from my investment. So Warren Buffett is somebody you can take a look at that quote. He's someone who when he invests, he cares a lot about high quality businesses. Seth Klarman, who is another value investor, and I think we'll read some excerpts from his book Margin of Safety at some point, points out the fact that I think it's easy to forget that when you are buying into a stock, you aren't just buying a piece of paper, you're buying a portion of a business. And so thinking about that underlying business is really important, and not losing sight of that is key. But what is a company's purpose, right? I think that's the thing that we have to ask ourselves before that, and that's going to help us build to this concept of business quality. Like what's a business supposed to do anyway? And the answer is to make an economic profit. So I think last week we talked a little bit about um, this idea of accounting versus economic profit, and the key thing here is that economic profit also takes into account opportunity costs. And so, what does that mean? If you let's start with the formula on the bottom of the slide. So, economic profit in this case refers to return on capital, which this is kind of like what accounting is trying to kind of think about, but it's not just the income statement because a portion of the costs associated with that are how much capital am I even putting into this business in the first place. But that's the first component of this, right? Like our accounting profit, our financial profit, our revenue minus our explicit costs. Um, but also, there's a cost of capital associated with this. And what that means is, I could have potentially earned a profit elsewhere with the resources and money and capital that I'm putting into this business. And so that's a portion of the cost. That's the portion of the cost associated with this business, right? And the reason why that actually goes into this is because if you take a look at this timeline we have, if I could have so say that I borrow $1, say this is debt and I'm borrowing $1, um, that's and there's an interest rate of 7% attached to that. Um, and then I turn around and I put that into a business in which I earn 12% profit from investing that dollar. Like I'm earning a 12% return every year. Um, my return is not just 12%, right? Because there are costs associated with borrowing that capital that are kind of derived from this idea of opportunity cost. And so at the end of the day, my economic profit is the difference between those two. So it's not just 12%, it's significantly less than that. Um, and so the idea of this is that you have to account for both, costs like we think about these explicit costs, like cost of inputs, operating expenses. We also have to take into account the cost of debt, the cost of using capital, like debt or equity. And those are tied. Those like I said a second ago, are kind of formed from this idea of opportunity cost. So this is how you would kind of think about this: revenue minus explicit cost minus opportunity cost. So let's focus on the first half of this, which is return on capital. And so that's this box on the left-hand side where we want to think about, what is kind of going into this like explicit costs, revenue difference. And there's a few different, and I think one thing we're going to highlight is that the income statement, which we kind of talked about earlier as kind of thinking it, like measuring the profit and loss associated with the business, doesn't actually adequately encapsulate what we're talking about here, because of the fact that when I put in, and I'm not talking about the cost of capital literally, I'm just talking about the fact that there are resources that have been put into building a business that need to be accounted for when I'm thinking about costs associated with business, or kind of the profit associated with the business. And an income statement doesn't really take into account that. And so there's three measurements we kind of think about when we want to think about the return on capital, right? The return on resources that we've invested into this business. One of them is ROA. So this is the profit the business generates for equity holders for each dollar of assets that the business holds or purchases or kind of has, right? So that's the formula right there. And so net income, which if you remember is the leftover, is the bottom line of this business, right? The profits after it's paid off all of its costs, including its obligations to the government, including its debt obligations like interest. That's the money you have left over. And so that goes to anyone who has equity in the business, right? Because equity is a residual claim on the business. And so this basically refers to, like, given a certain amount of assets that this business has, what is the return to equity from those assets? How well is it able to turn those assets into a bottom line for equity holders? ROA actually is a very important metric for banks, if you all remember the presentation from last week, which you don't, by the way. Return on equity is another way of thinking about the same thing, and it really is more of it's kind of a similar concept to ROA, but instead of assets in the bottom, we're asking ourselves, given the amount of resources that, each dollar of resources that equity holders have historically put into this company, just equity holders, not debt holders, not anybody else, what is the return, the residual income return to them? And so that's you have your book value at equity at the bottom. So it's more of like equity holders have put in these resources. What's the return to them versus how well is how well are equity holders being compensated from the general assets of the business, which is more of an ROA approach. But the most important, I would say, metric that we're going to talk about today is return on invested capital, which takes a different approach. And so this approach takes NOPAT on the top, which is net operating profit after taxes. We'll talk about what that means in a second. And then it takes a measure called invested capital in the bottom. And we'll break this down in a second. But the idea is we are trying to get a better sense of operationally what is the return this business is generating from the capital it has that's like actually tied up in business activities. So what's the business profit, kind of return to the business assets of this company, and we'll break down what that means in a second. But kind of going into the numerator of this NOPAT, this is net operating profit after taxes. So the reason, so this is kind of for a few things, right? So net means that we're excluding non-recurring gains or losses. Sometimes a business will sell a property, for example, and like a manufacturing business might sell a property, or like a software company might sell a property, right? Like that means that the company might recognize a gain. It might recognize some profit off of that sale of land. But I wouldn't really say that that's like that's a part of that company's business. And if I don't think that's like that really accurately tells the story of the company moving forward, I'm not going to include that in NOPAT, because that's like a one-time thing. And this could be for losses as well, like specific charges that they take, like a liability, like a legal charge they take in a certain year because they're getting sued. That would be something that I wouldn't, if I don't think that that's like an essential part of this business, it's going to recur moving forward, I wouldn't think about that. I wouldn't include that. So operating profit, which if we talked about last week, is kind of the profit that's available, that's generated from all business activities that's given to all stakeholders, right? Debt holders, equity holders, and if you want to think about the government as well. And so we start kind of from there, and then we take out taxes, because that is a cost on the return of all stakeholders from the business, debt or equity, right? So no matter what, you're going to have to pay your taxes, and so we want to take that out. And so in the previous slide, the little like tricky thing here is in the bottom of this, we've kind of said that operating income minus taxes is the profit available to all stakeholders. That is true, right? So that's true that once you take out taxes, that's what's available to all stakeholders. But if you saw on the previous slide, our numerator NOPAT was kind of generated from taking operating income, which we would then adjust for non-recurring gains and losses, but we multiplied it by 1 minus the effective tax rate, which is different from what we just did here at the bottom, where we just subtracted taxes. The former method, multiplying by 1 minus the effective tax rate, is the way to think about this. And the reason for that distinction is because the amount of taxes I actually end up paying in any given year is going to depend on the amount of interest, for example, that my business has, or the amount of like non-recurring gains and losses, because I might sell a business, like a piece of land, and that's counted as income that I'm going to have to pay taxes on, even if that's not really part of my business, right? So the idea of multiplying by 1 minus the effective tax rate is for us to kind of theoretically say what does the net operating profit what does NOPAT look like theoretically? Not thinking about the amount of interest this business has to pay, not thinking about these like non-recurring, non-operating gains and losses that I'm going to have to pay taxes on. Because if I use the actual tax amount, I'm taking that into account. So that's why it's that operating income times 1 minus the effective tax rate is not the amount of profit you have after taxes, but it's theoretically kind of what you would have if you it's theoretically kind of what you would have if you didn't have a lot of these costs that aren't associated with the operating characteristics of the business. So I know it's a little confusing, but I would long story short, use the formula on the previous slide. So this is our way of deriving NOPAT, which is the numerator. Invested capital is the denominator, and so invested capital is the total funds held on behalf of shareholders, lenders, like equity and debt holders, and any other financing sources. We haven't talked about preferred stock, minority interest, etc. But there's other ways to finance your business that we won't get into. And so it's calculated from the balance sheet, and it's basically all of the financial claims in the business, which corresponds to all of the resources that have been put into this business. And so this is the formula for calculating it. We take total debt, we take the total book value of equity or shareholders' equity, and then we subtract non-operating cash and assets. And so kind of like these are two questions when we're thinking about this, right? So first, why do we use NOPAT instead of net income, right? The idea is that, and I said this a second ago, NOPAT represents these after-tax profits that are available to all shareholders, and by shareholders I don't mean equity holders, right, or like holders of a share of stock of the company. I'm talking about all stakeholders in the company, like debt and equity holders. And that's also better because we're trying to think about a cost to what comes out of net income a lot of the time is interest, right? And so and also like things that are taken into account in net income include like these non-operating losses or gains that we talked about a second ago that don't really have to do with the operations of the business. But interest is another cost. It doesn't actually have to do with how healthy the business is. It has to do with sort of like the quality of the business itself. It has to do with how the business is financed. Maybe you have a great business that's had a lot of debt put on it, like in a leveraged buyout. You don't want to take that into account when you're thinking about what is this like inherent theoretical quality of the business. And so why do we subtract non-operating assets from invested capital? The idea is that invested capital can be used for a lot of different things, and it's not always used for being invested into the operations of a business, right? And so Apple is a great example of this, right? Like a good portion of Apple's like total assets are in cash. And so when we're thinking about kind of the whole idea of ROIC is you're asking the question, what is a business able to produce with what it has? Given some amount of resources, what kind of profit is it able to produce, right? And so a good portion of Apple's assets aren't tied up into things that kind of produce, that aren't tied up in its actual operations, right? They're just kind of tied up in cash. And so none of that cash is helping generate an operating profit, and so it's not part of the kind of capital and resources that are generating NOPAT for Apple. And so we don't want to think about. We want to say, given the amount of capital that's actually been invested into operations, what is the operating profit that's been able to be generated from that? And so. Because the cash that Apple has is just kind of lying around, and so it's not actually actively helping generate that operating profit. So it's kind of comparing operating profits to the assets that underlie those profits and help generate those profits. And that's even though like Apple holds a lot of cash, and that actually is like a thing that it does. We want to ask the question like, what theoretically does this underlying business quality look like? And we can only kind of answer that by thinking about the stuff of a business that's actually put into business operations. Hopefully that's clear. Again, we'll be having office hours Friday and Saturday to talk about this stuff. So if it's still unclear, come to office hours, ask some questions, or ask your discussion leader as well on Sunday. Okay. So why ROIC? So remember, this is the definition of each of these, just as a recap, each of these different metrics. Your ROA, it's kind of like the residual profit to equity holders for every dollar of assets. ROE is the same thing, but it's every dollar of equity that has historically been invested into the company, the book value of equity. And this is, and also, sorry, a portion of that is of that equity is kind of retained earnings that have been reinvested in the business. ROIC is the operating profit for every dollar invested in the business operations. And that you can think about that as stock and debt. So there's a few reasons why ROIC is important and why we think it's a good metric and a better metric. So one, it removes the effect of leverage. So if you kind of look on these three companies we have on the right hand side, if I have a lot of debt invested into the business, that boosts my ROE because that's kind of like resources that somebody else is giving the business that helps the business generate a profit. But I'm not even taking into account the fact that it might have a lot of debt on it, and that's the reason why my equity profit is so large. And so you can't really compare with ROE. You don't have a good sense of with just that metric. You don't have a good sense of how much leverage is playing into that calculation. And so ROIC also allows us to understand the true returns of the entire business. And what I mean by that is this goes back to our discussion of why we take out non-operating assets like cash and assets. And the idea is we have some amount of resources that are put into this actual business in business operations, and we want to think about what is the business profit from that. How much are we able to generate in operating profit from operations, like resources invested in actual operations. And then 3, ROA and ROE can be distorted by one-time events. Like I talked about the example of a software company or a manufacturing company selling a building or a piece of land, because net income doesn't account for that. So, that's not helpful when we're trying to think about business quality, because I wouldn't really say that a software company or a manufacturing company selling land and counting that as profit is real profit I want to be thinking about when I'm evaluating if this is a good business or not. And then we'll briefly talk about kind of one other way that we can break down ROIC and ROE into sort of like this formula is an example of, if you can cut off the denominator and you can just cut like revenue appears in the denominator and in the numerator, you can just cut that out, right? So obviously this is not this is adding some degree of complexity, but the reason why is that this formula is helpful to us in terms of kind of like showing what goes into ROIC in a different way. And the same thing for ROE. So turnover is just broadly the way that we think about how much sales a business is able to generate from a certain amount of resources that's been put into this company. And the margin, which is what we talked about last week, a margin for any kind of metric, for any kind of profit metric, is just that profit metric over revenue. So in the case of ROIC, we can think about this as the margin of NOPAT, like how many dollars of how much you get in NOPAT for every dollar of revenue, times the amount of sales that are being kicked up by resources invested into the business. And so we'll talk about in a second why that's helpful. But ROE is kind of the same thing, where you can think about the profit margin of the business, which is net income over revenue. You can think about the amount of sales that are being generated, sales or revenue that's being generated from a certain amount of resources or assets in the business. And then there's a final component here, and this is what we just talked about a second ago, where leverage is kind of adding to that. So total assets over book value of equity. Remember that total assets equals liabilities plus shareholders' equity. So the more debt I have, the more that portion of the formula is going to increase, and the higher my ROE is going to end up being. So that's the point of that's the reason why leverage kind of contributes to ROE broadly. All else equal, right? All else equal. Turnover equal, profit margin equal. If I'm able to boost leverage, I end up with which is a relationship that actually works for a lot of businesses. I'm able to boost ROE. So this is kind of the ROIC formula, but we're going to take a look at how this actually applies to a couple of different retailers. So keep in mind, ROIC is the margin times the turnover being, again, how much revenue I'm able to kind of produce for a certain amount of resources invested in the business. And so there's kind of two ways to think about a lot of retailers, which is like, what does the margin look like and what does the turnover look like? Walmart is an example of a low margin but a high turnover retailer, right? So there's a lot of sales that it's able to kind of generate per location for the amount of resources that's been invested in its business, but it doesn't make much money per sale. It's very, very thin margins, but it's just able to generate a lot of sales for every location it has, for the amount of resources that's been put into this business, which leads to a good ROIC. Hermes is an example of a luxury retailer, and it doesn't generate a lot of sales per location, but on each sale that it generates, it makes a good amount of profit, and so that also leads to a high ROIC. So sort of like, it's a good example of why thinking about in terms of this can actually be kind of helpful for understanding what builds to a good ROIC and how different businesses with different qualities can both have a good or similar ROIC. All right, we're going to switch gears and talk for a second about the cost of capital. So this is the opportunity cost that I've been, dancing around a little bit without without kind of diving into. And unfortunately, I'm still not going to fully get into this today. Well, that's a discussion for next week as well. But this is the other cost, right? You have your explicit costs, you have your cost of inputs, your operating expenses, that sort of thing. But you also have a cost associated with using that capital in your business. That is kind of generated from an opportunity cost. And that's, this is cost of debt, this is cost of equity. So before we kind of part of figuring this out is talking about the time value of money, right? This is really kind of the idea of opportunity cost. And it's it builds on this idea of comparing the value of things across different time periods. And so part of that is saying, the intuition here of comparing values across time periods is basically saying, what is the return I could be getting given some rate of return? What is the rate of return I could be getting if I didn't have this? And so the idea is like, okay, I think the easiest way to think about this is like, would I rather have $125 2 years from today or $100 now? Well, if I'm able to get a 10% return every year, $100 now is going to look like $121 in 2 years. So I'd rather have $125 in 2 years. And the same thing can be thought about kind of moving backwards. So like thinking about what the value of $125 is it's $103 right now, because that is the amount that given this 10% interest rate, like turns into $125 in 2 years. The reason for that is a little complicated and involves borrowing, but just kind of take it as like the current value of $125 in 2 years is the value right now that, given a 10% interest rate, would turn into that $125. So you can kind of think about the same thing for this $108 in year one. But basically the idea is like, we can then kind of say, look, $125 is the best option, because given this way we're comparing values across time, of thinking about the rate of interest we can get on them across time, that's clearly the best option. So we'll dive into this more again in the future, but this is kind of how to think about, just at a high level, how the time value of money works and how to compare values across different periods. So part of this is also thinking about the intuition behind the cost of capital. Again, we'll dive into really the details of this next week, but the idea is like, I would rather have money today than money tomorrow, because I can do stuff with that money today that will increase the amount of resources I have that will give me a return to that money, so that I can have more of it by the time that tomorrow rolls around. And so, yeah, the idea is like owning capital you can generate great like utility from that, but also like you can generate like activities that produce more capital in the future. So another component of this, which is the idea of risk and return, and basically broadly that just means that I want to be compensated for an additional unit of risk that I'm taking on by more return. So all else equal, if you have two different securities and they have two different levels of risk, I'm not going to invest in the one that has a higher level of risk if it's giving me the same return, right? Like, why would I put my money there? I can put it somewhere else where I'm getting that same return for less risk. So if there's a more risky investment, I also need to expect that I'm going to get a higher level of return on average and aggregate broadly from investing into that, because that return may not materialize because it's risky, right? Again, we'll talk about really what risk and return means, like moving on, but I hope that that's kind of intuitive, right? That if something is riskier, I want more compensation for taking on that risk, right? I'm not okay with the same amount of compensation. So in practice, this kind of goes into the way that we think about the cost of debt and the cost of equity. Debt is safer than equity, right? Like that's um, the first stake, the first claim that is paid off from the firm. Um, and so, equity has the residual claim after that. And so, um, correspondingly, the return to debt is going to be lower because the risk associated with debt is lower. And equity, correspondingly is going to be higher. The return is going to be higher because I'm taking on more risk. And so in the kind of we'll build to next week how we actually thinking about a percentage return that we would associate with debt or equity. But that's the general principle behind how I would think about any return broadly. So now let's kind of talk about, let's put these two concepts together. This is the left-hand side that we talked about earlier, is ROIC, right? It's how we think about revenue and costs associated with the business, the amount of capital that we've had to put into this business, and then, what's the cost of that capital? What's the opportunity cost associated with tying up resources into this opportunity versus somewhere else? And so economic profit is ROIC minus cost of capital. That's a really important formula, and it is a pretty big indicator of the amount of value that a business is generating. And the intuition is that a company's primary objective is to earn a return on capital greater than its cost of capital, because if it's not, then it's basically destroying value, right? Like I am putting in a lot of resources into this company, and the company has a certain amount of riskiness, and I could get a return somewhere else for that same amount of risk, but instead this company is giving me less than that return if the return on capital is less than its cost of capital. And so that's not a positive thing, and we would never want to invest into a business where that would be the case, because I could earn better returns elsewhere. And so this is just how you would build to put all these concepts together. The weighted average cost of capital is the way that we think about the cost of capital. It builds from those 4 line items below ROIC on the right column. We won't get into that today. We'll get into that in a week from now. But everything that builds to ROIC, you should kind of understand. And then the economic profit spread is just the delta between ROIC and the weighted average cost of capital. 5%, 14 minus 9. Okay, so now we're going to talk about, kind of take this to another level and talk a little bit about the power of compounding. And the idea is that generating high returns on invested capital, which is what we've kind of talked about as being a good metric for how strong a business is, that's important. But also another important thing is how much of that return that I'm generating, how much of that profit am I able to deploy back into my business? And so this is the formula that kind of encapsulates that, and that's the intrinsic value compounding rate is equivalent to ROIC times the reinvestment rate. And so kind of these are two companies, both have the same ROIC, but one can reinvest 100% of those earnings back into the business, whereas another one can only has the opportunity to reinvest half of those earnings. And so the intrinsic value of those two businesses is going to compound at vastly different rates. And so the reason for this intuitively is, if I think about what goes into ROIC, it's basically saying that I have some resources in my business that's kicking up some amount of profit, some amount of return. And how do I expand that return? How do I expand the resources and value of my business? I turn the return, I turn some portion of this return or profits. I take that, I put that back into my business, which then generates some more profits, right? So that's important because then those resources can be put back into my business and used to generate a greater profit in the future, right? So that's why reinvestment is so powerful, because it adds to the amount of capital that this business has, and again, that capital is generating some amount of return, right? So it's like a cycle that can continue. Can continue. Um, if I'm a business that doesn't have the opportunity to reinvest my earnings back into my business, that just limits the amount of value that my business can generate moving forward. And so a portion of this is thinking about growth or sustainable growth, and that a way that we can kind of think about that is the ROIC and the reinvestment rate. So I'm going to throw some challenging concepts at you in this slide. There's a lot going on here, but kind of bear with me and go back and re-listen to this a couple of times if that is kind of what it takes to get it right. So ROIC is actually like a fairly straightforward concept. That is the return on incremented invested capital. You can think about this actually as like kind of like the going forward, like the derivative of ROIC moving forward. And it's basically saying, if I think about a business deploying an additional amount of capital, what is that incremental return, that marginal return it's going to get on that amount of like new capital it's deploying, right? So like, to give you an example, I might have a business that has a bunch of different locations and a certain amount, which would fall under its invested capital, and it's generating a certain amount of operating profit or NOPAT from that, net operating profit after taxes from that. And now I'm opening up a new location that's an incremental amount of capital I'm deploying. And my question is, how much NOPAT, additional NOPAT, incremental NOPAT is that new location going to generate, right? So it's basically saying, what is the kind of like ROIC of that next unit of the business that's kind of being deployed. So that's what ROIC means. And so the reinvestment rate is the amount of incremental capital that has been invested over a certain period over the total amount of earnings that have been generated in that period. And so, I mean, that's pretty straightforward. That's basically saying, I have put in this much more capital into my business over this time period, but how much earnings did I generate over that period, and how much did I actually generate? And then it's taking the amount of capital that I've actually put into my business and putting it over that, right? It's saying, given this earnings I've generated over a period, how much did I actually turn around and put back into my business? So, the left-hand side and kind of shows an example when it comes to Walmart between 2006 and 2016 over the course of 10 years. And so you can kind of think about this in two ways. So first, when we're talking about the ROIC, right? So Walmart had gained, increased its net income by $3.5 billion between 2016 and 2006, right? So it's got $3.5 billion of additional net income, and in the same period, it invested into its business. The amount of capital in its business increased from 76 billion to 110 billion, which is a total increase of 34.5 billion. So when we were calculating the ROIC, remember that's the incremental earnings, so over the incremental invested capital in the same period. So Walmart deployed $34.5 billion of capital into its business over the course of 10 years, and that resulted, in a change of net income of $3.5 billion. So the catch here, as you've probably noticed, is that we aren't excuse me, we are thinking about this in terms of net income and not NOPAT. That's kind of a simplification because we're trying to see the amount of earnings that we have kind of available to us at the end that we can put back into our business. And in the case of ROIC, it's a little bit less important to use NOPAT because we think that a lot of the costs associated with like these non-recurring costs and these interest costs are already kind of factored in both cases. And so the additional 3.5 billion change is also kind of a NOPAT change. So that's a simplification again, but that's why we use net income. And so basically, we've been able to generate 10% ROIC on those additional capital investments that have been made over those 10 years. And then, our question is, what is the reinvestment rate? And so if you look at the bottom half of that left-hand column, you see that the cumulative 10-year earnings for Walmart over that period, basically how much net retained earnings has increased over or changed over that time period is how much retained earnings has changed over that time period is 147.9 billion. And so that's how much we've earned, or Walmart has earned over those 10 years. And of that 147.9 billion that it's earned, it has put forward 34.5 billion of that into capital investments. So it's able to reinvest 23.3% of the earnings that it's generated over that period. And so basically what ends up happening is we multiply the reinvestment rate by the return on the incremental capital investments, ROIC, and that gives us an idea of how much the company's how much the company grew over that period. This is basically saying, given some amount of capital or resources of value of this business, how much is that able to grow? Because that a portion of that is how much is being earned off this ROIC, and then how much of that is sort of being so how much of that is being earned in net income, which is being turned around and invested to the business through ROIC and the reinvestment rate. So this is kind of just thinking about how much the intrinsic value of this business is compounding through the mechanism of being deployed as capital, earning a return and being reinvested into the business. That's kind of intuitively what's going on there. And so you can see that kind of matches. It's not too far away from the CAGR of the Walmart stock. Companies that are, it's not growing its intrinsic value all that fast, and so the equity, the growth in the equity value of the stock is going to kind of match that, broadly speaking. I mean that has a lot of assumptions inherent in it, but the fact that this company is not compounding its value too fast means that from an investor perspective, we probably don't think the equity value is going to increase that dramatically over that time period as well. Okay. Let's talk about ROIC and earnings growth. So basically the point of this slide is to illustrate the fact that a lot of investors focus on growth, like how much is earnings growing from year to year, and try to focus on investments in which they think earnings growth is going to continue. But ROIC is an important metric because when we think about taking a set of companies that have high ROIC versus taking a set of companies that have high earnings growth, those companies that have high ROIC are more durable. That high ROIC is more durable over time. And so earnings growth very quickly falls back down to earth. Companies with high earnings growth, often, most of them over time will quickly mean revert. But ROIC is much more durable and persistent and stays higher for longer because of the fundamental factors that contribute to high ROIC. So that's just kind of an important thing to think about when we're thinking about business quality. Like high ROIC is durable, high earnings growth is often not. Depends on the situation, but this is kind of broadly the case. And that's why a lot of investors focus on ROIC as a metric for thinking about good businesses. So let's talk about protecting an economic profit. Um, so this kind of leads into this question of how does a business persistently earn more than its cost of capital, right? We talked about that earlier. That's really important. That's how you're kind of generating value broadly. You're earning a return that is greater than its cost of capital. But actually, that's kind of a challenging thing to do for like a persistent period of time, because when there's an economic profit, people move into that space. They try to take that profit, and generally it decreases. So, how do we figure out if this is the case, if this will continue into the future? How do we figure out if this is a persistent fact of this business? And the answer is competitive advantages. Persistent profits don't come from growth, but they come from competitive advantages. And you can see that cheesy Microsoft Word image on the left side. And the idea of this is like a company needs something that prevents other people from entering their market and replicating their business. And a competitive advantage is just that. It's something different about a company or a set of companies that allows them to persistently outcompete new entrants, existing competitors, and earn an economic profit. And then, earning a return on their capital above the cost of capital over an extended period of time. So competitive advantages come from three main sources. This is like very generic and certainly oversimplified. But you can think about cost advantages, so being able to persistently gain products, manufacture products, produce services for a lower cost than other people, which means if you think about it, generating a greater profit per unit than other people, than other competitors in your market. And so it also, which also means you could potentially lower your prices and still make money, and drive your competitors out of business. It also comes from differentiation, so being able to sell a product at a premium versus other competitors, so you just earn higher margins from that, or you match prices and people just choose your business because you're higher quality or you're better, or you're differentiated in some way. And then focus is not really a fantastic one, but it, if a business is like has a particular niche somewhere, that sometimes leads to a competitive advantage, but typically not a very durable one. So I wouldn't ironically, I would not focus very much on the third one. Moats. So how do we think about kind of like thinking about? I mean, the concept of a moat is basically a competitive advantage that is sustainable for a long period of time. And so, an example of a great moat is Apple, right? Like, one of these real like economic moats associated with Apple is the brand name. So again, I'm less convinced that a brand name is an important economic moat, but a huge moat is that Apple has this ecosystem from the App Store, right, which is like a real moat, to little things like iMessage or the integration between people's Macs and their iPhones, or the different services you use on an iPhone. Like that creates high switching costs, which we'll talk about in a second, which creates a strong economic moat. And so more transient competitive advantages, so things that we might consider competitive advantages, but we don't think, quite meet the meaty definition of a moat, are like, good technology, just like better technology generally, a couple of deals that mean that like there's exclusive album releases on Apple Music. Moats are the key to long-term economic profits, and high-quality businesses have moats. They're often characterized by strong barriers to entry. They're often very inherent to the business. but they can change over time. Um, and they can be analyzed by looking at this spread, the economic profit spread that you think about as the difference between ROIC and the cost of capital. If a business is doing that for a long period of time, decades potentially, you think there's probably something going on moat-wise. Not necessarily, but probably. Like that's one of the strongest indications that a business has a moat. So the most common types of moats are kind of intangible assets, switching costs, network effects, cost advantages, and efficient scale. And we'll kind of go through those one by one, but on the right side you can see a bunch of companies that kind of really fit that each of those moats. So intangible assets. So just basically anything that you can't really touch, but generates a real strong moat for a business. So a good example of this, maybe not the best example of this, but an example of this is brand name. So the thing about brand name is that it really depends on the business, right? Like having a great brand name in fashion might be really good for a week. It might be good for a few months. It might be valid for a few decades, right? So it really depends on the industry in which you're operating in. Patents are another one. Patents are intangible assets, which allow a company to typically, in the case of a lot of these intangible assets you're talking about, being able to operate in a differentiated way. So patents, allow companies to charge a higher price. Patents are transient, however, in that they, you can patent something, but at some point that's going to run out. But they can often last for decades, which is a really good source of a moat because it's government protected, which licenses and government approval is another one. Trade secrets. So this is an example of something. If you don't think something can be replicated, it's a very unique example, and I don't think that the recipe of Coca-Cola is probably what has made it successful for so long, but that's an example of like a potential competitive advantage. Corporate culture. Again, this is not the strongest moat, but some companies, some people argue that some companies like McKinsey, for example, have a specific corporate culture that's contributed to their success. Again, I wouldn't really consider this. I certainly wouldn't consider this a moat, but maybe it's an example of some sort of transient competitive advantage. Another competitive advantage is switching costs. So high costs that dissuade customers from switching to another product, brand, or service. Basically, this is the idea of this is like it is costly for me to move my business away from you. In software, a lot of people learn how to use Photoshop and Microsoft Office specifically, and so if you develop that very specific skill set of learning these types of software, or even like a lot of things are just compatible with that software, which also is kind of a network effect, which we'll talk about in a second. Like that means that implements a high switching cost. Surgical supplies and manufacturing can be like this too, where I integrate with a manufacturer. They specialize their manufacturing process to me. I specialize like the way that I think about my supply chain to whatever they're doing, and so that kind of like integration between us leads to high switching costs. Surgical supplies, you get kind of like very specifically used to some types of supplies, and so it's more challenging to move over to another brand or competitor. Okay, network effects. So this is one of the most powerful types of competitive advantages you can have. Basically, the idea is as the more people use an offering, it gets more valuable, right? And so, or the more kind of like more customers or participants use the network, the more valuable it gets. And so I'll only kind of talk about a couple of these because I think that you'll generally get the concept after that. But the idea is like, I don't know, for Amazon, the more merchants that are on Amazon, the more people will come on Amazon to buy stuff, which means that more merchants will want to come on Amazon because there's more customers, right? The cycle continues. For payments, The more merchants that accept a card, the more people are incentivized to have that card because they can use it a lot of places. And the more people that have that card, the more merchants are incentivized to take it as a method of payment. Social media, stock exchanges all work the same way. These are really powerful network effects and the ones that kind of underlie a lot of the big technology companies right now. Cost advantages. So the idea here is this allows firms to maintain low operating expenses relative to competitors, and they can either undercut competition or just generate higher returns given some amount of competition. And so there's a couple of examples of this. Economies of scale is a big one. So the bigger that I have these massive investments that are associated with building up massive fixed costs that are associated with building up fleets and distribution centers, but the bigger I am, the more that I can spread those costs across many different units sold, which means that I make more money, I'm more profitable the more people that I serve. And so the bigger I am, the cheaper I can provide that service and kind of the lower cost my service is. So distribution, logistics companies fall under this. Manufacturing like semiconductors are a really great example of this. So I think those are companies that really benefit from economies of scale. A low-cost resource base is another example. So if you think about so I should say Saudi Aramco, but if I basically have access to some resources, this happens a lot of the time for natural resources companies. If I have access to some resources that nobody else has, then or resources that are just cheaper in some way to extract, then I am going to operate at a lower cost. And so Saudi Aramco is a great example because they have a unique access to oil at a very cheap break-even price, which allows them to have a sustainable cost advantage over other competitors. So, efficient scale, this kind of refers to the idea that this market is really only big enough for a couple of players. And so because of that, naturally some barriers to entry open up. And so one example of this is not to keep referencing this presentation, but the community bank presentation that was given last week, in which basically only one competitor can really compete in that market. It gets established. No one else really tries to enter because you just can't have two competitors in the market, right? So it's more of just a rational barrier entry that kind of is created. And so it's founded less on some of the things that we talked about earlier, and maybe more on just sort of exogenous market factors that limit the amount of people that can compete in that market and the attractiveness of kind of competition in that market. So very niche markets can sometimes fit this build. So what's not an economic mode? These are kind of very common ones that get thrown out a lot. And so I think they're important ones to kind of dispel. Market share is not an economic moat. In some areas, serving as many people as possible, in some businesses, serving as many people as possible leads to a moat, right? If size, in terms of economies of scale, do, but this isn't always the case, right? And so you've had many companies throughout history that have had high market share that have quickly lost a lot of that market share because they didn't have a moat to back that up. So market share in itself is not a moat. Technology is not a moat. Technology, in a lot of cases, is constantly getting better, and so you have companies that are constantly competing to be kind of to leapfrog the current status quo of technology and make the next big thing. It constantly gets better, and so it's very challenging to say I have the best technology right now, and therefore that's a compelling moat. That's not really a sustainable thing. Again, a hot product doesn't make a moat. Things are popular in the current moment, and that doesn't mean that they're going to be popular moving forward. Process and management are the same thing. Like, again, just given what we've said before, don't fit the conditions of an economic mode. So I think part of this is the language that we're using here. A competitive advantage is basically something that allows me to earn an economic profit in a business, potentially allows me to earn a greater economic profit than the competitors in my industry, or competitors in my business line. But that doesn't have to exist for a year, a month, a day for us to sometimes use a language of a competitive advantage. And so that's where this language of a moat, this term of a moat, comes in, where it refers to these competitive advantages that are actually durable and sustainable over long periods of time. And that's what really translates into business quality. There's a range of businesses that, like most businesses do not have a moat, right? Like most businesses don't kind of benefit from being those high quality businesses. But when a competitive advantage is very sustainable over a long period of time, we call it an economic moat. And so, I can sit here and define, this is a moat, this isn't. But I think the important thing for you all is when you are going out there and thinking about companies and thinking about businesses, again, they don't have to have moats for us to invest in them. But if you're asking the question, like, does this company have a sustainable competitive advantage? Does this company look like it has a moat moving forward? The question is, does the advantage that it has allow it to kind of maintain that advantage? Is the inherent aspect of that advantage that it continues into the future? And for most companies, the answer is no. And so only for like some very specific high quality companies do we see that being the case. So I think it's not just about kind of thinking about the categories I've given you here. It's about thinking, like using your own critical thinking and saying, can this be replicated? Can this be used? Is this something that can be sustainable moving forward? Okay. So one way we think about trying to put all of this together and thinking about competitive analysis is Porter's 5 forces. And so this is like a common framework people use for competitive analysis. And so, this comes from the idea that competition is not just about the products you're selling, it's also about, for example, Coke and Pepsi. A huge portion of that is distribution. Competition changes over time, industries evolve, and firms aren't just competing with their direct competitors, they're also essentially in competition with suppliers, customers, and substitute profits. Like that's translating into whether or not they're making money at the end of the day. And so there's so many different factors that translate into competition. We didn't put this on here so that you had to learn all of them. The idea is just that, like, look, there's so many different things that go into like kind of like what translates into a business being successful and competing. And so in order to kind of like synthesize all of that into one way of thinking about things, there's just Porter's 5 forces is a framework. It's a commonly used framework, but it's a framework. It's just one of many frameworks used to assess the attractiveness of a business on the basis of competition within its industry. And so the idea is to just highlight areas in which the industry that a business operates in serves it well or doesn't serve it well. Thinks of like another way of us thinking about competitive advantages and disadvantages. And so maybe also trying to understand kind of what contributes to a company being successful for a long period of time or not for a long period of time. So this is what the 5 forces model looks like. And so we'll kind of go through this one by one and kind of talk about what each thing means. So let's start off with threat of new entry. And so this, to me, is one of the most important of the 5 forces, maybe the most important of the 5 forces, which is, how easy is it for new competitors to enter in this space? So the basic idea is that like if I'm earning a high return, high returns on capital relative to my cost of capital, if I'm earning, really nice economic profits, people are going to want that. People are going to want a piece of that pie, and so entrants are going to kind of come into the market, are going to want to come into the market. If they're successful, they're going to decrease profitability for all firms because they're going to increase competition and supply. So how can an incumbent firm have a low threat of entry? Barriers to entry. So there's so many different things that contribute to that, but the idea is like is that like if a business is if there's not something about a business that's able to keep other competitors from entering into the market, that's a challenge for that business. And so Boeing is an example of a company that's a high barrier to entry, right? So Boeing produces planes, right? And so it has extremely complicated manufacturing processes and like deep relationships with all sorts of different both airlines, but also air companies very specific companies that buy airplanes. And so because of the fact that this is like an extremely complicated process that requires lots of capital, lots of expertise, and also orders in advance, trust is hugely important in this industry, and Boeing has trust because of the history of it being one of really two players in the industry. So that's why that's kind of a duopoly industry and why Boeing has high barriers to entry. Polaroid has low because for a while it had a patent on, you can see the little footnote there. It had a patent on instant photography, but then once that patent expired, there was no real barrier for Kodak to kind of move into the market and replicate Polaroid's process, which ended up making the company far less profitable. So next we'll talk about threat of substitutes. The idea is like, well, what else out there could potentially decrease kind of the demand for my product and my ability to kind of raise prices, right? Because if I start to raise prices too much, people will switch over to something else. And so a lot of the degree of thinking about that has to do with switching costs. How hard is it to switch over? A lot of other things that I'm not going to read off. But for example, Uber can only raise its prices so much before people start thinking about Lyft. Both of those two can only raise their prices together so much before people start using public transportation, or biking or whatever, right? Like, I think this concept is fairly intuitive, but the more substitutes out there limit my ability to generate economic profits. Bargaining power of suppliers. So the idea is that like if I have powerful suppliers, I end up potentially being far less profitable. And the idea is that suppliers can charge better terms for themselves, higher prices, which raises my costs, which decreases the profits that I'm making. So here's a few examples. Boeing's there again. Boeing and Airbus since there's only a couple of them, and they control a vast majority of the airplane manufacturing out there, especially for commercial jets, they can charge really high prices generally because, there's not that many suppliers out there. So people only have a couple of different, only really have two manufacturers to turn to. Another example, I'm going to skip down on this list, Foxconn. So Foxconn is a manufacturer for a lot of Apple's products, and so it's very crucial to Apple. It's done a lot of the it manufactures just like it's specialized in it, and it's been integrated to Apple's supply chain for a long time, and so it's very important. It's very crucial to that supplier, to the buyer, to Apple, and so it's able to kind of demand pretty good terms from Apple and kind of increase the prices it charges, which decreases Apple's profit. I'm not going to go through each one of these things because, again, there's a whole list of them. But basically, the general concept is that suppliers end up charging higher prices because of their negotiating situation, because of the leverage that they have in the relationship due to whatever kind of fundamental factors influence that, which, higher prices for from suppliers means higher costs for a business, which means decreased profits. Bargaining power of buyers. So this is the other side of that, right? Like, how powerful are the buyers that I have? Again, so, you know, a good example of, like there's a laundry list of how this might happen. It's kind of a very similar concept to supplier power. But, there's lots of different substitutes to JCPenney. There's not too many substitutes in terms of brand name to Gucci. I don't know. I'm not very knowledgeable about fashion, but this is an example that is given. And so basically you're asking the same principle, which is like, how much does a buyer depend on this company to supply it? If I'm the exclusive supplier of this product, if there's not that many suppliers, then my buyers, my customers are not going to be that powerful. But if they are, and there's lots of different businesses that do what I do, or there's only a couple of buyers of my product, and so they each kind of have a big chunk of my business and thus have a lot of leverage over me, they can demand lower prices. And so when they have lower prices, that means it's less revenue for me. That's lower prices for my business, which means less profits, right? At the end of the day, it always relates back to how is this business able to generate profits. The final kind of thing is how do we think about the rivalry among existing competitors? And so high competition reduces profitability, right? This just makes sense. And so there's a lot of different factors that would go into this. Once again, if you have like slow industry growth, that means the amount of returns available to each company is pretty low, and so people are trying to generate higher returns by grabbing market share from each other. This could, but the idea is like if you only have a couple of competitors in a space, that may not necessarily be the case, and so they might just decide like this is an example of kind of collusion in market practices. But like if there's only a couple of competitors, they might say, hey, like let's all keep prices high. We're in a better position if we just don't lower our prices or we don't mess with each other's markets, with whatever markets kind of we're concentrating on. So maybe that results in lower existing competition. All right, let's take a look at a case study that kind of ties all this stuff together. So this is Starbucks. So most people should be familiar with this, hopefully. Actually, if you're not, that's okay. But basically, it's a coffee company, right? That has lots of different branches across the world. And so the rivalry among existing competitors is quite high. There's lots of different competitors out there, right? McDonald's, Caribou, Pete's, Dunkin' Donuts, so many different small coffee shops nowadays. So there's lots of different competition. And so because coffee is not super different from store to store, right? Like it is a little bit, but not much. They're often competing on price. And they're trying to kind of expand into each other's territories internationally. The bargaining power of buyers is quite high. There's many different buyers, but also like, they don't have any switching costs. There's so many different choices out there. And so like, they're able to see what the prices are in different places. And so since the product is relatively undifferentiated, they have, a pretty good degree of buyer power. Although the one caveat is that like, people kind of like people will often choose one coffee shop to go to repeatedly. So you might have some degree of like switching cost associated with habit there, where people will come back and you can maybe raise prices a little bit. And that same customer who has a habit of coming there will like eat that price up to a certain point. And so then the bargaining power of suppliers is actually kind of moderate in this industry. So there's not that many areas in the world that can grow coffee beans, which limits the number of suppliers, but there are also a lot of different suppliers in this market. So I'd say moderate to low is probably the best characterization of competition in this specific industry. Then the threat of substitutes is actually Yeah, it's, I would say low, right? Like the idea is like, there's tea, there's juice, there's soft drinks, but like currently in the current in the current zeitgeist of things, like there's just not like a very obvious um, alternative to coffee right now. But maybe people, maybe there's going to be an increased trend to go to like to brew coffee at home. There's also bars and pubs if you're kind of thinking broadly as like what a substitute for um, going to a coffee shop with a friend is. But generally, it doesn't seem like coffee shops are going away anywhere anytime soon. And one key thing to think about here when we're talking about data substitutes, we're talking about substitute products entirely, right? So not just talking about like Pete's Coffee versus Starbucks. We're thinking about substitutes for the entire um, industry overall, right? Of like coffee shops. Threat of entry is actually probably relatively low. So I would caveat this with the fact that each Starbucks competes in a market in which the threat of new entry is probably fairly moderate to high. Most markets are fairly saturated at this point, right? Where you have a lot of coffee shops, but it's not that hard to open a coffee shop. Um, but on a nationwide level, it's very hard to achieve that kind of scale that Starbucks has, and like that kind of national like headspace. So I would I would probably argue the threat of entry is more like moderate, but um, you know, depends how you kind of think about this market. Again, that's a good example of the idea that like you can reach different conclusions about this, about like these factors, just depending on how you think about it differently. Um, so the kind of conclusion about this is is just that it's kind of a mixed bag. There's like high current competition, um, but generally demand for this stays quite high and is growing internationally. So you have kind of a generally like mixed bag when it comes to how this shakes out, right? So it's like the challenge with Porter's five forces is like you're able to kind of think about individually how each factor relates to the quality of the business, but putting it all together is is a task for like it's not just like a procedural task, right? You have to think about how to put them all together, how they all kind of move together. Um, some common pitfalls is like you have to really think about what you're going to choose as the industry, and that's really important in terms of like you're going to want to pick an industry that you think is like really this is the basis of competition. These are really the real main competitors because if you say something like okay for coffee shops, I think that I think that libraries and bookstores and like bars and pubs and household coffee and grocery stores, are all different competitors. Like you're technically right in some capacity, but you're kind of missing the general basis of competition that happens in this industry. Um, yeah, don't make a bunch of lists, right? Like that we've listed out a bunch of different factors in each of these things, but like you want to generally synthesize that into a kind of like sense of in into like a kind of sense of what each factor kind of contributes to the quality of the business. Sometimes some forces don't really matter for the business, right? Like for some of them, we just really didn't really think about that too much, and we had like a low or moderate sense of that because frankly they don't really impact that business that much relative to other businesses, right? It's either like kind of an ambiguous effect on the business in terms of like how much does it really affect the business, or it's just like a very normal or average effect to that business. Like it's an average threat of substitutes, an average threat of new entry. It's kind of just like the general principle for that business. And so some of these forces are going to be really important relative to the other ones for some businesses. They're not all equally important, right? You're not just taking an average of all of like your lows, your moderates, and your highs, and you're getting some evaluation of business quality. Industries change over time. Trends are important. You want to make sure that you're thinking about changes that are happening right now as and really evaluating which ones are fundamentally changing the nature of an industry, like which ones are real secular trends versus just, um, you know, what's hot in the industry right now and what might go away in the future. And so you don't really want. I think it's kind of synthesizing this at the end of the day to say this is attractive or unattractive is probably less important of the point here. Um, you do like there's some degree of synthesis that's necessary in thinking about this business, but the ultimate thing is not just, hey, is this an attractive industry or not? It's how is this an attractive industry? How is it not? What do I think this contributes to in terms of the business's profits moving forward? Um, that's the real eventual question that we have to get to. So I think it's very easy to sort of get lost in the labeling of each of these forces instead of thinking just broadly about how do I think these all come together to determine the profits of a business moving forward, which is a challenging task sometimes, but it requires kind of focusing in on a few of these forces, I would say. This has been a long presentation. If you've made it this far, which I hope all of you have, props to you. Um, this so investing is about buying fractional ownership in a business. So we care about business quality. High quality businesses are those that are able to earn returns above their cost of capital, and I would say that persistently, right? Like over time. That's this big key point as well. Investing is all about looking into the future and trying to see what's going to happen. Competitive analysis kind of gives us the tools to think about that, because for question number 2, that all has to do with the fundamentals of the business, right? That's really fundamentally sort of like what's driving the ability to earn economic profits over time. Number 4, we already talked about moats or sustainable competitive advantages. Those are important. We're trying to predict the future a lot of the times when it comes to investing, and so, knowing that business quality is going to stay over time is important. Most investors spend a lot of time thinking about this. This is the last thing that I'll say. Most investors spend a lot of time thinking about this because, like you saw with Porter's 5 forces, there are so many different forces that kind of go into what makes a business strong or not. And so thinking about how it's going to evolve moving forward is tricky. Like, how's the business going to look like moving forward? That's not easy. But it's important, right? And it's important for us to have a sense of what's important and what's not in these factors, because there's so many things that are going on, and seeing the important things and seeing the things that are going to be valuable to this business earning profits in the future is the most important thing. Alrighty. This slide doesn't really help us at all because I can't get questions from my computer, but hopefully this is helpful. Hopefully you're able to kind of like watch this a couple of times or parts of it a couple of times if you have any questions. As always, you're welcome to shoot an email to your discussion section leader. And I think Milena is having office hours on Friday from 12 to 1 p.m. in Booth. I will send out a time for office hours on Saturday as well. So if you have any questions, feel free to come by to either. And I will see you all next week.